Okay, let's dive right into this explainer. Look, the AI market today is frankly deafening. We are constantly bombarded with new models and, frankly, astronomical valuations. So, how do you actually separate the companies with a real, durable future from the ones just riding the wave? Well, today, we're going to use a structured business framework to cut through all that noise and find where the durable value in artificial intelligence actually lives. To understand where we're at right now, we kind of have to look backward. Because every major technological revolution throughout history, it follows a really specific pattern. Think back to the railroad boom of the 19th century. As this massive new technology emerged, over 700 railroad companies sprang up out of nowhere. Capital just indiscriminately flooded the market. But what actually happened? Well, a pretty brutal sorting process took place. Most of those 700 companies failed or got swallowed up. But the very few that survived, they literally built the infrastructure that the entire country ran on for generations. And we saw the exact same thing happen much more recently. Just compare that railroad boom to the internet bubble of the late 90s. Thousands of companies popped up with billion-dollar valuations, but their business plans were built on, let's be honest, pure optimism rather than actual economics. Most vanished within 3 years, but the rare survivors, the Amazons, the Googles, because they had real, durable advantages, they went on to become some of the most valuable companies in human history. It's always the same story. A transformative tech arrives, money floods in, and then a massive sorting process separates the durable from the doomed. So, to figure out who survives this time, here's our roadmap. First, we'll look at the great sorting process. Second, the competitive moat framework. Third, analyzing AI market layers. And finally, the ultimate AI winners. Let's kick things off with Section 1, the great sorting process. Because right now, we are squarely in the middle of exactly that. The tricky part for anyone trying to navigate this space today is that the hype and the reality are totally tangled up together. Unlike the dot-com era, where a lot of those hyped companies had literally zero revenue, today's different. The AI companies commanding premium valuations right now, they're actually generating real revenue, and they're growing fast. The tech is clearly real. So the trap isn't figuring out if AI actually works. The trap is figuring out who has built advantages that will last, and who is just benefiting from a rising tide that's going to lift all their competitors right up there with them. Which brings us right to Section 2, the competitive moat framework. To separate that hype from the real durable value, we need to completely shift our perspective. We need to establish a really core business concept here, and that is the competitive moat. This is the absolute foundation of long-term value. Put simply, a moat is whatever makes it incredibly hard for a competitor to take your customers or market share, even if they have the exact same technology and incredibly deep pockets. In the AI space, moats come in a few very specific forms. And let me just be clear about this. Not every company slapping AI on their website actually has one. The first, and honestly, arguably the most powerful form of an AI moat is data. It's simple. Machine learning models get better when they have more data and better data. So a company that's stockpiled proprietary data sets that competitors just can't easily replicate, they hold a massive structural advantage. And that advantage actually compounds over time. Think about it. A model trained on a decade of unique proprietary behavioral data is always going to outperform a model trained just on publicly available internet stuff. This gives companies with massive existing user bases a sort of hidden advantage that pure-play AI startups literally cannot buy their way into. Now, the second form of moat is distribution. Having the absolute best, most cutting-edge AI model means next to nothing if you can't get it in front of customers efficiently. And this is the often overlooked, massive advantage of the large incumbent tech giants. Look, they might not always have the flashiest research breakthrough in a given month, but they already have the deep enterprise relationships. They have the trusted brands, the established sales teams. They already have the distribution pipes running right into every major corporation on Earth. That means they can deploy AI capabilities at a fraction of the cost of a new startup. The third moat is compute infrastructure. Training and running these massive AI models takes an enormous amount of specialized computing power. So companies that have either designed their own chips or managed to secure long-term access to the best hardware at a massive scale, they have a distinct cost and performance advantage. It creates this huge, incredibly expensive barrier for any new entrant trying to catch up. Okay, so we have our three moats: data, distribution, and compute infrastructure. Let's move to Section 3, analyzing AI market layers, and see how these moats map onto today's actual market. When you apply that moat framework to the landscape, a really clear hierarchy pops out. We can basically break the market into 3 layers. You've got semiconductors at the foundation, cloud infrastructure in the middle, and the application layer sitting on top. Let's walk through this matrix methodically so we can see exactly where the durable value lives. Down at the very foundation, we have the semiconductor layer. This is the absolute bedrock of the AI industry right now. The companies designing the hardware that trains and runs AI models, they are sitting in a position of extraordinary leverage. Why? Because literally every single AI company needs their chips. When demand is outstripping supply like it is, the chip designer captures enormous value, regardless of which specific software app ends up winning. Plus, their dominance is protected by really high switching costs, incredibly sticky proprietary software ecosystems, and years of optimization that are almost impossible to replicate overnight. Sitting just above that, we have the cloud infrastructure layer. The dominant cloud providers are spending hundreds of billions of dollars to build out AI infrastructure. They're essentially becoming the necessary pipes through which everyone else accesses AI. If a mid-sized company wants to use AI, they're going through these platforms. Now, these relationships are very sticky, and the scale advantages are huge, but there is a catch here. These giants are competing so aggressively with each other that it keeps pricing pressure high, and that naturally limits the profit margins any single one of them can pull in. Now, before we hit the very top layer, I want to give a stark warning. Picking stocks based on flashy software demos is not investing. As our source material brilliantly puts it, it is speculation dressed up in analytical language. Keep that in the back of your mind as we enter the most dangerous part of the market. Welcome to the application layer. This is where companies are building products directly on top of those underlying AI models. You know, your AI writing tools, coding assistants, customer service bots, that kind of thing. And honestly, this is where the most confusion and the most danger lives. The valuations here are extreme compared to actual revenue, mostly because people just assume today's leader in a category will somehow keep that leadership forever as the tech matures. But we need to seriously question that assumption. Because of what we call the commoditization trap, the core issue is that the underlying AI models are turning into commodities way faster than anyone expected. Imagine you build a fantastic AI app. Step 1, a major player like OpenAI drops a brand new, way more powerful base model. Step 2, great news, your app automatically gets smarter. But here is step 3, the trap. Every single competing application gets just as smart overnight. Whatever differentiation you had 6 months ago literally evaporates instantly because a model update just leveled the playing field for anyone who lacks a true defensible moat. Now, there are always exceptions, right? Some application layer companies will absolutely survive and thrive, but only if they have real moats. So what does that actually look like? Well, first, deep workflow integration. If removing the AI tool would genuinely break a client's daily operations, that creates massive switching costs. Second, operating in heavily regulated industries. Generic AI tools can't easily jump the high hurdles for validation and audit trails that a specialized tool can. Or third, having unique self-generating data loops. This is where a company's existing business feeds proprietary data right back into their models, giving them a compounding advantage that pure software competitors just don't have. All right, let's zoom out for our final section. We need a historical insight that's going to totally reframe this whole conversation. Section 4, the ultimate AI winners. Here is the crucial point. When you look at the history of transformative technologies, the biggest long-term winners are often not the builders who create the tech itself. Instead, the real winners are the transformers, the companies that figure out how to use that new technology to completely reinvent an existing industry. I mean, think about it. Amazon didn't invent the internet. They just used it to totally transform retail, and then logistics, and then enterprise computing. Which leads us to a pretty incredible twist. Fast forward a decade from now, and the most valuable AI companies might not actually be the tech startups building models today. The future AI titans could actually be traditional non-tech businesses. We're talking about insurance companies, massive healthcare systems, financial institutions, industrial businesses. The ultimate winners are going to be the companies that figure out how to deploy AI to fundamentally alter their core economics, basically leaving their rivals in the dust while everyone else is still just running pilot programs. This technology is undeniably real, and the opportunity here is massive, but getting involved requires brutal honesty about what you're actually looking at. If you're just buying into a company because it slapped AI in its name and the chart happens to be pointing up, well, you don't have a thesis. You're just buying the hype. You have to be able to articulate specifically what makes a company harder to compete with: its data, its distribution, its infrastructure, as this technology matures. So I'll leave you with this one provocative challenge. When you look at the AI landscape, are you buying a real thesis with durable advantages? Because ultimately, the price you pay for this opportunity is going to determine whether it becomes your wealth or just a really expensive lesson.